Welcome to Investors Insights. Our topic today is a tornado of market activity. We chose that for several reasons, and I'm joined this morning by my distinguished colleagues, Trey Booth, Adam Van Zant, Bobby Norman, and Ty Miller. We've just come out of a meeting where there was a lot of debate and discussion, and we will continue those talks, not only in this vlog, but also on all our social media, Facebook, LinkedIn, Twitter, YouTube, as well as our podcast. We also are continuing to speak to groups and thrilled to get back with people to interact and answer their questions. So with that said, Trey, why don't you start us off? Because you're really the reason we got the title this morning, Tornado of Market Activity. You woke us up with that line.
Yeah, Greg, thanks. So this is definitely an enormous week in terms of the markets and economic data. So on Wednesday, the Federal Reserve will announce their decision on rates. And then on Thursday, we'll get the first look at second quarter GDP. The reason we use the word tornado is because we're seeing it in the bond market, a really big battle in the bond market between those two data points. We've got the Federal Reserve, which is fighting inflation, which means to fight inflation, that's pushing interest rates higher. Right, the market all but is priced in a 75 basis point rate hike on Wednesday. But then on Thursday, we've got GDP coming out, and many market participants expect GDP to be down and that we may be going into or in a recession. And when you have GDP falling, that brings interest rates down as people buy fixed assets and try and risk off. So you have higher inflation, Federal Reserve raising rates on one hand, and then interest rates coming down because of fear of GDP slowing on the other. So you're seeing the 3-month T-bill, which is the short-term treasury. Interest rates on the last month of that are up 82 basis points, has moved from 1.56% all the way up to 2.38%. On the other end, though, the 10-year treasury has moved from 3.16% all the way down to 2.79%. So you've got the bond market really battling over, do we need to slow down and pull down interest rates because we're going into recession, or the Fed's fighting inflation, so interest rates have to go higher. And so all that won't be resolved this week, but we'll get two enormous data points on whether or not we're in a recession. And the bond market, which is much larger than the stock market, often then can pull the stock market one way or the other. And that's where it kind of really spreads to the rest of your investments, whether or not we're in a recession, whether or not the Fed is fighting inflation. Those two data points will come out strong this week.
Well, and people are watching rates, not only because of their portfolios, but it's also if you want to loan at the bank, what's money market rates paying these days? And also, what about that mortgage? So especially if it's adjustable rate. So there's a lot of rippling effects in the economy tied to that bond market and what's taking place in the Fed's decision this week. So it was well done, well explained. But Bobby, you started pounding on the table and you said, let me tell you something about corporate earnings here, because of the fact what we're seeing in some aspects of the bond market is the stock markets and corporate earnings are telling us something different. Is that right?
Yeah, Greg, two positive developments that I want to talk about from last week. The first one, we have been looking for momentum or investor enthusiasm, and we finally got that last Tuesday as the S&P 500 had a 2.8% advance, and 98% of the S&P 500 stocks were higher for the day on Tuesday. That was actually the strongest reading since January 4th, 2019. So for us, strong breadth is a signal of recovering demand for equities, and it's something we believe is necessary to turn this market around. Also, another positive development for the market, as you can see in this chart, is with 21% of the S&P 500 companies reporting earnings so far, 75% of companies have beaten analyst earnings targets, and earnings and revenue are tracking for a 5 to 10.5% increase. So it's a positive sign that, one, we're seeing investor enthusiasm again, and then also earnings growth in the midst of negative overall economic headlines. So good news.
Yeah, and it's something that the media is definitely not talking about as you know, those earnings are coming out. And so everybody keeps talking about what the Fed's going to do, but I think that's a really great point that you brought up, and we all thoroughly appreciate your research on that. Ty, you were talking about cash this morning and the amount of cash. Talk about why that's so important, the cash on the sidelines right now.
To Bobby's point, we had some strong technical data. We've had some good earnings reports so far. Another sign, maybe more on the, if you think of the opposite way, is in a survey by Bank of America, they surveyed 300 money managers. They're holding like 6.1% cash right now, which is the highest level since 2001. when in the survey, 79% of those managers were bearish on the near-term future. When you get a lot of sentiment like that, a big cash position, 79% bearish, add on to that margin debt is at its lowest level since 2009. When you get a lot of these signs, they're interpreted or they're kind of related typically to market bottoms. Now, we're not calling a bottom here, for certain, but of course, maybe this is a sign, hopefully inflation peaks. Maybe this is a sign that the worst is behind us.
And you're right. And if people are watching our vlogs and go back to last week, we started talking about that, how lumber prices and other commodity prices are down. We've been highlighting that. And here we've got another example that maybe we're starting to see cracks in inflation and a lot of positive news coming our way. And Adam, we saw some stability, I think, in the 50-day moving average. You were talking about that this morning. Bring us up to date on what you're tracking from a technical analysis standpoint.
Absolutely, Greg. I appreciate it. We heard Bobby talk about the S&P a little bit, but last Tuesday marked the highest close for the S&P 500 since June 9th. That momentum carried through the week through Friday, closing at 3,961. Also give us a new resistance level of 4,000, new support level of 3,920. Greg, to your point, with the 50-day moving day average of the S&P 500, it's currently sitting at 3,919. We're starting to see that stabilize. You might also notice that that's very close to our support level. So as we see the Fed speak this week and some more earnings coming out in the next few weeks, that's a very important number to keep an eye on.
It definitely is an important number. I totally agree with you, Adam. And let me say this to our viewers, is that today is July 25th. In 5 months, we will be in holiday season. This year will be heading to being over, and we will be heading into 2023. We've had a topic today of tornado of market activity, and we're lining up to let you know that in the next 5 months, we've got a lot of things coming our way from a portfolio strategy, as well as in relation to your financial blueprints, and we're going to keep you updated. A lot of good news out there, and we're going to keep you updated as well as to how that information works in relation to some of the negative things that you're hearing about. We hope you have a great week. We're going to close out the month of July. Continue to track us on social media, and don't hesitate to call or email us or do a virtual meeting with us, because we're always open to that. Have a great week. Thanks.